Hey, it's Chris. Happy Friday. And you know what? It's hard to deliver bad news, but sometimes bad news with a little bit of understanding can help. So many people thought, oh, because the Fed's cutting rates, that interest rates were going to go down, and mortgage wise anyway, and just stay down. Of course, if you've been watching my videos, you know I've said this is a possibility, and I told you it was a 50-50% chance this would happen. So what is going on? Well, at the end of the day, the jobs market, jobs report is really what's driving interest rates more than the Fed rate cuts. So the 10-year Treasury, this is the ultimate benchmark for mortgage rates, has gone up significantly. So if we take a peek at this thing, we can see we are back up over 4%. Now, right before the Fed cut interest rates, we were down at 3.6. So we've basically gone up 0.4% on the 10-year Treasury, and that's because of the job market being strong jobs report. So right now, jobs trumps everything. It used to be inflation trumps everything, but right now it is jobs that trumps everything. So looking at this, we can see we had from that September Fed rate cut till now, interest rates have gone up 0.4%. And we're actually lucky that interest rates are as good as they are on mortgages. So this right here is mortgage rates. This right here, we're looking at 6.06, just right around, very close to 6%. And now here we are today, national average, 20% down, good credit, 6.64. And that's not a no-point deal. That's the average person paying 0.6 in points. So why are we lucky? That sounds terrible, right? Well, we are lucky because the last time the 10-year Treasury is at 4.1%, well, that was back here in November of 2023. And guess what? Interest rates were 7.5, 7.6, because the spread or the distance between the 10-year Treasury and mortgages was actually greater. So I know it doesn't sound great, but at the end of the day, we're pretty lucky right now to not have 7.5% mortgages, because this right here is the spread between the 10-year Treasury and mortgages. And you can see in 2023, we're hovering right around that 3% mark, meaning that mortgages was basically the 10-year Treasury plus 3%. Now we're the 10-year Treasury plus 2.3%. So we're pretty lucky to be in this lower spread environment. Now, a normal spread is 1.75 to 2. So you can see we haven't had that in quite a while. We did have it, at the beginning of 2022, but that's right when interest rates were starting to climb. So right now, there's two things that can improve interest rates. One, weaker jobs, and two, improved spreads. The improved spreads will come in time. So eventually that comes, but that's going to take, my guess is probably another 4 to 6 months. Some weakness in jobs, that's what we need to get some lower interest rates. If you have any questions about financing a home, give us a call. Have a great Friday.